What's up, everyone, and welcome to the daily macro update for Wednesday, September 3rd. Taking a look at the chart of gold here, gold continues its rally here and breaking out after its 4-month consolidation period on the signal of more stagflationary conditions. This is shown by the inflation nowcasts from not only the Cleveland Fed's inflation nowcast here with CPI, headline CPI, going from 2.8% to 2.9%, as well as core PCE, staying around, 2.9, 3.0%. And also as well, you have, when you take a look at the 5-year break-even inflation rate, even though it did have a little bit of a down day today, if we take a look at this, this has been continuing higher, making a series of higher highs and higher lows pretty much ever since mid-May, right? And so the bond market, as well as lots of different economists, are forecasting inflation to at least remain sticky. It may not accelerate like we saw all the way back during the years of 2022, up to 9% inflation. I don't think that's what's going to happen here, but it could take a lot longer for inflation to come down. And so with that, that's really been pushing the long end of the yield curve higher, which, as you can see here, this is the, we look at 20-year bond yields, 30-year bond yields, which did tap around 5% early this morning, as well as the 10-year U.S. government bond yield. But really, it's the 20 and the 30-year that remain, higher, and then the 10-year yield is in bearish trend. And so, that is somewhat of good news for, people who are looking for, things like mortgage rates and credit card rates to come down. But as you can see, excuse me, we are still at a much higher rate. And so it would still take a decent amount of downward force for the 10-year yield to actually be felt in things like mortgage rates and credit card APR. So we're still pretty far from that. I would want to see this coming down all the way down to like 3.2%. So about 100 basis points from where we are at currently with this. And so that, along with, the Fed having a pretty high likelihood that they're going to cut by 25 basis points, apparently after today's job openings and layover turnover survey report, the JOLTS survey, this did have another deceleration to a 10-month low, but I think that, this might be short-lived, as when you take a look at the actual year-over-year rate of change, it's actually improving. So we'll get into that momentarily here. But one of the big indicators that I like to take a look at is the 13-week Treasury bill. This chart here has a very good track record of front-running, Fed cuts, and the ticker for that is IRX.P. But taking a look at this, it has dropped off to new local lows around 40, which means, the Fed, it's pricing in the Fed is going to cut rates by about 25 basis points. And so, that's pretty much being priced into the bond market as well as the futures market. And so for those people who, disagree with the Fed's actions, I'm sure the long end of the curve is going to agree with you, but unfortunately, they're going to do what they're going to do, and the short end is going, as well as the futures market, is going to disagree with you. So, this is a similar kind of scenario to what we saw last year, although it's not exact, only because when we take a look at the long end of the yield curve, such as the 30-year U.S. Bond yield, look what it was all the way back from where it was mid-September last year when they cut by 50 basis points. So remember, there was a lot of inflation or recession fears, and so you had the U.S. 30-year go from about 4.7% all the way down to 3.9%, so nearly a 100 basis point drawdown in the U.S. 30-year on long end yields. But then the bond market quickly realized that the inflation dragon was not slayed, and so then it went in the opposite direction, even though the Fed cut their Fed funds rate. And so as you can see here, the bond market could revolt if they're not going to get it right. And so, just zooming out here, here we are a year later, heading into the September FOMC press conference, and it's actually the exact opposite, right? So the 30-year is much higher, and so if the Fed gets it wrong for the second year in a row, then I wouldn't be surprised if you see 30-year bond yields go even higher into the fives from here. Similar to what we saw all the way back in October of 2023, as well as very briefly for about a day in about May of this year, right? So there is that to watch, but in any case, it doesn't mean that, you should be fearful. What it just means is that you want to be able to hedge yourself against the stagflationary environment with things like precious metals, specifically with gold as well as silver. And then if you want a little bit more bang for your buck, gold miners as well as silver miners, and silver junior miners and gold junior miners continue to outperform even those itself, right? So even though, things are looking a little bit grim in terms of, the rate cutting side from here after this meeting, you still are having bull markets in different areas other than the S&P 500 and Bitcoin. Even though Bitcoin, speaking of that, has had a little bit of a pop here, it still remains in a bearish trend. It would have to, close above this 114,500 mark, which has a little bit it could do that, but it does have a little bit of room to go there. Ethereum, Solana, AVAX still having, great price action here. So those remain bullish. A little bit of a correction there from Bitcoin miners. The S&P 500 did have a little bit of a pop there from yesterday's low end of the trading range. And so, hopefully you are selling some into, after that pop. It is interesting how, this is showing a bit of a deceleration. Hopefully you're noticing the slowdown in volume here. And so, as you can see, let me just, this is the volume performance indicator that my team and I created. This essentially shows the average 1 week, 1 month, and 3 month volume performance. And so, as you can see, if you wanted to just look at a more immediate term, you can just take away the 3 month, and it shows the 1 month versus the 1 week. 1 week being green, 1 month being blue. And typically, when the 1 week average volume performance goes below the 1 month, that's typically a sign of slowing volume, right? And then at the same time, you have to look at this metric and say, okay, what is price doing at that point? And so as you can see, volume has been declining on this uptrend here. And so let me just make some markers just to show you guys the key interest points, right? So you had the cross right there. And then you had a local peak right there. And so what's interesting is that, as prices were bouncing here, what did you have? Or what are we continuing to see? That is a bearish divergence, right? Now, that doesn't mean that we're going bearish on the S&P 500 on a trend basis, right? The trend fully remains bullish and intact, hence the green bookshelf in the background, right? It remains in bullish trend. But you do have to recognize this pretty interesting and stark bearish divergence. The reason why we created this volume performance indicator below, which is a free indicator, you guys can just look me up on TradingView, is because if you just use the in-house one on TradingView, which shows the bars and the average, it's a little bit hard to see kind of like the trends, right? It kind of looks very shallow. And so we created this metric to really showcase more of the volume trend and give you guys a better idea of where volume is headed. And then while I'm on the topic, another indicator that I like to use that I didn't create myself, but I do use it a lot. This one is called the net volume, positive and negative volume. And so this shows the net cumulative volume of whatever ticker that you have. So what's interesting is that this is starting to weaken compared to where it was last time. And so whenever you have these large red zones, that's typically when sell volume is starting to really take over, and you can change the time frames on that. Even though I typically stay on the daily time frame, those are probably the two most important volume trend indicators that I personally use in order to spot these divergences. And so, yeah, pretty much since volume has been decelerating here and having this bearish divergence, since August, it's been a great time to sell some in order to buy more on the next dip. So, yeah, continuing to see that bearish divergence there. Qs having a little bit of a pop. Russell 2000, the better performer. And then in terms of mega caps, check out Google. Look at this huge pop on accelerating volume, right? That's really what you want to see in a bullish trend. And we were talking about this the other night in last night's Macro Madness live stream, which is our private group session with just the partnership circle members in our community. But yeah, we were talking about Google and some other things that have been performing extremely well, even in this condition set, better than the S&P 500. And so yeah, Google right now with about 3 minutes left in the close here continues higher. And yeah, we're also seeing a large move in Apple here, and that's pretty interesting too. Our model went bullish on Apple officially on August 7th. And, since then, Apple has had a decent, 8% move since it went bullish on our model. And it continues to look like it's strengthening from here. Okay, let's go ahead and get into some of the macro data here with the job openings and labor turnover survey report. If we take a look at just the nominal number here, yes, you did have another deceleration in job openings. But what you have to understand is that with the job openings report, you have to look at the entire thing in the context of job openings, as well as hires, the quits rate, as well as the layovers, right? And so even though you see a deceleration nominally in the job openings, if you're not seeing layoffs accelerate and you're not seeing quits really go up, then it's kind of a nothing burger. And so I think that we'll continue to see that depending how things go for the rest of the week here. But let me just show you the year-over-year rate of change, which shows that the rate of change of job openings has actually been improving since the April 2024 lows. And so even though on the mainstream media you see headlines like this, you have to make sure that you're taking a look at the year-over-year rate of change, which again, this has been showing an improvement. Really, the lows for the rate of change was actually July of 2023. Close to having a revisit in September of 2024. But, ever since then, it went positive on June of 2025 for the first time really since July of 2022. And so, as you can see there, it has been improving. When we take a look at layoffs, this is the year-over-year rate of change of layoffs. Those have pretty much remained flat, not seeing a huge spike there. Hiring has also been accelerating here since the lows in July of 2024. So hiring in the private sector has actually improved. Quits has gone down, which again, quits only matters if you're also seeing a large spike in layoffs, which is, not what we're seeing right now. And then I saw someone post an interesting chart of the quits rate for the construction sector. And so as you can see here, they were pointing out how the quits rate for construction dropped to levels that we haven't seen since post 2008 great financial crisis. But again, you have to look at it in the context of the entire report here, right? So job openings for construction accelerated, while hiring pretty much remained flat, but still positive. Layoffs, you did see another acceleration there, but nothing, not a huge spike to the level that we saw similar to March of 2023. And then so, with that in the context of this low quits rate, you're not necessarily seeing something dire happen in the construction market, even though it is, that typically front runs slowdown. And then really where you're seeing the most drop off is in government jobs, right? So job openings in the government sector continue to remain deeply negative. When we take a look at hiring as well, hiring is negative for government jobs. Layoffs are negative, and quits continues to decline as well. And so we also got durable goods, new orders for manufacturing. That had a large deceleration, mostly a normalization from the large increase for tariff expectations. And so when you take a look at the core non-durable goods orders, so this is non-defense capital goods excluding aircraft, as you can see here, that has continued to accelerate from the lows back in August of 2023. And yeah, it's at 4.13%, which is pretty much, the norm that we see pre-pandemic. And so a lot of these different signals today, even though, you continue to see how the 10-year yield swings sharply lower because the JOLTS fell more than expected, as well as factory orders contracted sharply for the second straight month. They're talking about either month-over-month numbers, which is really noisy, or they're talking about the nominal number, which really doesn't matter too much. What matters is the actual accelerations or decelerations with those. So with that, I really think that this move by the bond market may be short-lived. We could see, a pretty decent rebound here, especially on the long end of the curve. But speaking of the yield curve, I wanted to quickly just go through kind of, the transitions of the yield curve all the way back going from the past couple of years. And so I'll move my face out of the way here just so that you can see this a little bit better. That one. There we go. All right. So looking at the yield curve here, this is what it looked like back in September 3rd of 2021. So exactly 4 years ago. Now, fast forwarding to early September of 2022, the following year, as you can see with the Fed raising interest rates, this flattened the curve. You started to see a large acceleration in short end as well in the long end, but this was a flattening due to raising interest rates. And then we went from 2022, a year later, to early September of 2023. This actually showed an inverted yield curve, right? So you had the short end of the curve, 1 month, 3 month, 6 month, 1 year, 2 year, all above the rate of the long end of the curve, right? And so that's where you saw that inversion in 2023. And then a year later comes around in 2024, and you started to see a steepening finally of the yield curve, right? And so this was where you saw a continued deceleration in the long end of the curve. But, you started to see some of the middle parts come down a little bit, right? So a large drop off in, let's just say, the 5 year, right? So this went from 4.3% to 3.5%. The 3 year bond yield went from 4.6% in 2022 to 3.6%, so nearly a 100 basis point decline. And this was anticipation of the rate cuts that happened in 2024, right? Now, let's go to from where we were at 1 year ago to right now. And as you can see, we see a large acceleration in the long end of the yield curve, right? And so you saw from this time last year, the short end of the yield curve has definitely come down on anticipation of further rate cuts, even though you really haven't gotten those too much. You've pretty much had from this time last year a full 100 basis points reduction in rates, which the actual Fed funds rate has to catch up to this. I'm comparing the green to the very dark blue here. But what's interesting is that the long end of the yield curve has gone up a lot, right? So this essentially has increased by 100 basis points, signaling that either growth or inflation is remaining sticky comparative to what they're doing at the short end of the curve, right? So typically bond yields move in a similar direction, and then what constitutes as a steepening or a flattening is the rate difference. So if the long end of the yield curve rises faster than the short end of the yield curve rises, then you get more of a bear steepening, right? Which is typically a signal of a healthy economy. And then, if you have the 2-year yield falling faster than the long end of the curve, the 10-year yield, then that's more of a bull steepening or Fed rate cuts. But right now, we are seeing a rise in the long end and a drop in the short end. So yields on the opposite end of the curve are going in opposite directions. They're not going in the same direction. And so what that is showcasing is more of a stagflationary policy mistake by the Fed, because the bond market is signaling stickier inflation while they are cutting rates into this. And so it's no surprise that within this setup here, gold has been performing incredibly well, right? Now, just going from 1 year ago to then 6 months later, you can see this progression of how this is happening here, right? So this is from 1 year ago to March of 2025 this year. And then we go from March of this year to June of this year, right? So you see how you had a large increase in the long end of the curve. And then from June of this year to currently, you've really had kind of a stabilization of the long end of the curve. But now the short end of the curve continues to drop, right? And so you kind of get this interesting, this is a 3-month trend. You get this interesting Nike swoosh, right? And then if we wanted to just look at 1 month ago, you're continuing to just see the long end of the yield curve move higher. And so this is what the current yield curve looks like to date. And so what's interesting is that when you have this Nike swoop, it's not necessarily a signal of a healthier economy, right? An example of a healthy economy would be back, or an overheated economy would be back, looking at 2021, which looks like this, right? See how you're not seeing that Nike swoosh? Whereas today, that's what you're seeing. And so, yeah, this is obviously not the best look, but let me see if I can actually pull up the yield curve phase signal chart that we made for our members. So we're kind of getting this inverted hump, right? So you're seeing how this is like an inverted Nike swoosh, right? So this is typically, we're getting an opposite humped version of this, right? So this is when 2-year yields are dropping while 10-year yields are rising. And so this is just whenever you get this weird hump happen in the yield curve, this is really just highlighting the uncertainty in the bond market right now, right? So very interesting setup that's happening. This is really uncommon, by the way. This is something that you do not see all the time. And so, with that, I just wanted to show kind of the progression of the yield curve there. And all of this to say is that, with this uncertainty with the with bond yields, it's no surprise why things like gold over the past few years, look what it's been doing. It's been going straight vertical, completely wiping out any type of, or not wiping out, but out competing the S&P 500, right? So if we take a look and put the SPX on the same percentage scale, as you can see, since we can just go post-pandemic here, as you can see, let me see here, since the pandemic, it's pretty close actually, post-pandemic, but if we go from the bottom of the bear market, so in 2022, if you were to buy the bottom of the bear market, gold is up 110% compared to the S&P 500, up 78%. And then if you want to just do year to date, the S&P 500 is up 9.88%, while gold is up 35.83%. So more than a 3x that you're getting gold versus the S&P. And you're not really hearing too many people talk about gold in the mainstream media, although, you'd think that they'd be talking more about something that's, outpacing the market by 3 times, but you don't really hear it that often. Even more so with 1 year. On a 5-year basis, it's pretty even, but on a 1-year basis, 42% gold versus 16% S&P 500. Come on. Pretty ridiculous there. So one ratio that I do like to look at as well when taking out the factor of dollar devaluation is taking a look at the S&P 500 versus gold, right? So this is essentially if the stock market was denominated in a hard currency. Instead of dollars, it's denominated in gold. And as you can see, even going back, let's go back on a weekly time frame here, going all the way back to, this ratio where it's at right now. The S&P 500 is pretty much flat since June of 2015, right? It had its largest run up from COVID up to 2021, but really since 2021, the S&P 500 has been in a pretty clear bear market, right? So far in 2025, the S&P 500, so stocks have been really depreciating in real terms, and in terms of a real currency. The S&P 500 has not been able to catch up. And so, when you think about it this way, are stocks really going up in value, or is it just the government printing away dollars into oblivion, right? Is it that denominator that's just shrinking, not the numerator increasing? It's pretty much the same reason why, since the pandemic, home prices have gone up a lot, especially used homes where, maybe they haven't even done any type of renovations. Maybe they slapped, a paint job on the side of the house, but really no major improvements, yet prices are up 50%, and in some places, double, even though it's the same house. That's what we're seeing in terms of this post-pandemic environment, right? So yeah, the S&P 500 has been in a bear market for the past 4 years here, and in terms of like a hard currency and in real terms. And so I like to look at this too because it does showcase like what the actual person is feeling as well. Pretty much since the peak in 2021, the average person in the lower 50% of income earners in the United States have been in a recession. You can clearly see it in this chart right here in real terms. All right. All right, I've yapped enough. Let's go ahead and get into some questions here. First, taking a look at YouTube. Why does gold tend to spike during Asia trading times? I'm not sure. Even if your model doesn't show the S&P 500 in a bearish trend, once you see volume and momentum start to slow, do you start to slowly decrease your portion size when buying dips? That's a huge part of the process, Matthew. You are absolutely right. And no pun intended because your last name is WRIGT, but that is correct. When it comes to bullish assets that are getting less bullish, when you start to notice divergences in price versus volume or price versus volatility, you are 100% correct in that you don't want to just go all in on these things when they get to the low end of the trading range, because not all bullish assets at the low end of the trading range are created equal. Some things have better strength and momentum than others, and it's those that you want to prioritize. And the ones that are starting to have signals of their momentum slowing, you do not want to prioritize those. And so the S&P 500 would definitely be an example of that because of the diverging volume that we see, as well as two. Let's take a look at volatility as well. 30-day versus 90-day historical volatility. You started to see a little bit of a spike with the 30-day getting above the 90-day, but it has since then, kind of contracted here a little bit this week. And so you're not having a huge volatility spike, but you are seeing, so you're not seeing a large bearish divergence in volatility, although, it's definitely higher from where it was just at the end of August, which was at around, 5.87, and now the 30-day volatility is at 9.33. So it's definitely an acceleration, just not a very aggressive one. It's a very small divergence that we're seeing from volume and volatility here. But yeah, you're 100% correct. It is losing some momentum, and there are better things to own. All right, let's take a look at some of the comments here on Instagram. Is the September rate cut a sell the news for risk assets such as crypto? Well, you're not going to know that information until, it actually happens. We're just going to follow what the trends are saying. And right now, Bitcoin, still, even though it's had a nice little bounce here, remains in a bearish trend. But Ethereum and Solana and AVAX remain in a bullish trend. So, there's a lot of those top altcoins that are performing well, as well as Bitcoin miners. All right. Lastly here, let's just go ahead and take a look at some of the questions from TikTok. Appreciate all the likes. Potato Head. Your usernames crack me up. Yep, that's right. The trend always takes priority. Do you see altcoin season Q4? Well, you're already seeing an Ethereum and DeFi season go on right now. So, yeah, who knows if a more broad altcoin season is coming. Not sure if that's going to happen, but I'm still just going to remain in the trends that I'm seeing. And right now it's Ethereum season and DeFi season. And so it's going to continue that way until otherwise. But all right, we're reaching up to 4:20 here Eastern time. So we're going to go ahead and close it out there. I appreciate everyone for joining, and I will catch you in tomorrow's daily macro update. Bye, everyone.